Welcome to the deep dive, where we take a stack of information and, well, really extract those essential nuggets of knowledge for you.
Good to be here.
Today, we're plunging into the fascinating world of financial analysis, specifically a pretty innovative way to look at company performance and, true value creation.
Yeah, it's an interesting angle.
We're going to unpack a concept called return on incrementally invested capital, or ROIC, and how a fresh look at it can maybe open entirely new doors for investors. Think of it like putting a new high-definition lens on your financial kaleidoscope. Suddenly you see these intricate patterns, these strategic insights you hadn't seen before.
That's a good analogy.
So our mission today really is threefold. First, clearly explain ROIC. Second, draw some analogies to its more well-known cousin, ROIC.
Right, the baseline.
Exactly. And finally, show you exactly what decomposing these metrics can do for your understanding of a company's strategy and the genuine value it's creating.
That's a good plan.
All right, let's dive in maybe with something many of you likely already have in your analytical toolkit. Return on invested capital, ROIC.
Standard stuff, yeah.
Often seen as like a cornerstone for judging efficiency. At its core, it's simple. Net operating profit after tax, NOPAT, divided by invested capital.
Basically, how well are they using all the money tied up in the business to make profits?
Right, just the overall picture.
But the real power of ROIC, and studies really back this up, is its direct link to a company's intrinsic value.
Oh, interesting. So it's not just an accounting number.
Not at all. Researchers like Michael Mabusson, Dan Callahan, they've shown this strong, pretty undeniable link between a company's relative ROIC performance and its total shareholder return.
Okay.
So companies that consistently improve their ROIC, move up in those ROIC quintiles, they often see significantly higher returns. It's actually a predictor of wealth creation.
That's a powerful statement about its impact. But, as investors, we often need to dig deeper than just one number, right?
Absolutely. An aggregate can hide a lot.
Yeah. So what happens when we want to understand how a company got that ROIC? How do we break it down? That's where something like DuPont decomposition comes in and sort of unzips ROIC.
Exactly. DuPont takes that single ROIC number and turns it into this powerful diagnostic tool. It shows ROIC as a function of NOPAT margin.
Which is NOPAT over sales.
Right. Profitability per sale. Multiplied by invested capital turnover.
Sales over invested capital. How efficiently assets generate sales.
Precisely. So you're looking at profit per sale and asset efficiency together.
So if I'm getting this right, this decomposition isn't just math. It's actually revealing the basic business strategy.
That's it. That's the power. It tells you how they're choosing to compete to boost that capital efficiency.
Oh, wow. Okay.
Absolutely. If we connect this to the bigger picture, you can discern strategy almost immediately. Think about it. A high NOPAT margin often signals differentiation.
Like a luxury brand or something.
Exactly, Hermes. Maybe a specialized software company. Premium pricing. Unique stuff driving profit per sale. On the other hand, high capital turnover might mean a production or cost advantage.
Like Costco. Or maybe Amazon.
Good examples. Discount retailers, logistics giants. They excel at moving high volume efficiently with their assets. Very rarely do companies manage both high margin and high turnover sustainably.
So the decomposition gives you that strategic snapshot right away. Are they competing on price and efficiency or on being premium and unique?
You got it. It's an immediate strategic read for you.
Okay, that makes perfect sense. So what this boiled down to is if a company's NOPAT margin goes up more than the inverse of its invest capital turnover, ROIC improves, value is created.
That's the dynamic.
It helps us understand the different roads companies take, boosting profit per sale or using assets better. Let's imagine Growth Builders, Inc., maybe a mid-cap construction tech company you follow.
Okay.
If Growth Builders improves its ROIC, this decomposition helps us see why. Is it because they started charging more for their tech? Better NOPAT margin.
Or maybe.
Or are they deploying their equipment way more efficiently across more projects, better capital turnover?
Exactly. It pins down the driver.
So understanding that interplay is great for the ROIC snapshot. But here's the kicker. ROIC is, it's a historical average, right? All capital ever invested.
Looks backwards, essentially.
Yeah. What if we want to understand the health, the effectiveness of their latest moves, their new growth plans? That's where our star today, ROIC, comes in.
Return on incrementally invested capital.
Right. The incremental view.
And this raises a really important question. Why look at these incremental changes? Why bother?
Good point. Why?
Well, the motivation here is to develop a more dynamic, kind of forward-looking yardstick. for evaluating progress when a company's trying to grow.
Okay.
You see, even if a company's overall ROIC is falling, maybe because of old inefficient assets dragging the average down, it can still be creating significant value for you, the investor, as long as its ROI, the return on its new investments, is higher than its cost of capital.
Ah, okay. So the new money has to clear that hurdle rate.
Exactly. That cost of capital is the minimum return needed to keep both equity and debt holders happy. Think of it as the company's hurdle rate. If the new projects are clearing it, they're building wealth.
Even if the old stuff is dragging down the average ROIC.
Precisely. It's about the health of their recent growth initiatives. That's the focus.
That clarifies the why beautifully. Now, the article we're exploring highlights something crucial about ROIC. It can be positive in two ways.
Right.
Either both NOPAT and invested capital go up, which seems intuitive for growth, or, interestingly, both can decrease.
Yeah. That second one needs a closer look.
Right. So a good negative ROIC could actually mean higher NOPAT with lower invested capital, which is clearly value accretive, right? More profit, less capital.
Absolutely adds shareholder wealth. Yeah. Imagine growth builders streamlining, selling off junk assets, but boosting NOPAT. That's a win.
Definitely. Conversely, a bad negative ROIC would be lower NOPAT with more invested capital.
Ouch. That's a definite red flag. Investing more, getting less profit back, not good.
No. So what's really fascinating here, according to the source material, is the novelty of applying DuPont decomposition to ROIC.
It seems intuitive, right, once you hear it.
Yeah, exactly. But apparently, it's kind of an undiscovered technique. The author even checked with AI, apparently, which confirmed it seemed original.
Wow.
So the small and somewhat obvious step, as they put it, could open up significant analytical potential for you.
That is quite a claim. It's exciting if true.
But given how intuitive it sounds now, why do you think it hasn't been widely adopted or even spotted before? Any practical hurdles? Data issues, maybe?
That's a really good question. Often, the financial world can be slow to pick up new metrics. Old habits die hard.
True.
Plus, calculating incremental values accurately. That needs good, granular data. Not always easy to get from standard financials.
Okay, data challenges.
Could be. But the beauty of this author's approach is trying to make it accessible. To make the decomposition clearer, the article uses this clever way to measure the shifts. They use multiplicative factors.
Like growth multipliers.
Yeah, let's call them that. A for changes in NOPAT, A for changes in sales, C for changes in invested capital.
Okay, so if growth builders NOPAT grew 10%, A is 1.10.
Exactly. If sales shrunk 5%, B is 0.95.
Got it.
These factors allow for this precise, almost surgical way to measure the incremental shifts, like a direct gauge of recent growth or contraction in each bit.
Okay, so what does this all mean for you, the investor, looking at growth builders' latest moves? By applying this DuPont decomposition to ROIA,
we can now express ROIC as the change in margin times the change in capital turnover.
Right. A powerful new tool, evaluating incremental margins and incremental capital turnover, giving you a much more granular view of recent strategy.
And this novel technique allows for a much deeper dive into value creation strategy and how it's evolving. It gives you several key insights.
Like what?
Well, think of it like this. Traditional ROIC, that's a still photo of the company's whole life efficiency. This ROIC decomposition, it's like a high-def video of its recent strategic plays.
Okay, I like that. Video versus photo.
It really gives you, first, dynamic investment assessment. You can evaluate the efficiency of recent investments, the immediate success of new strategies.
So for growth builders, is their new AI planning thing actually yielding profit or just eating capital?
Exactly. Second, marginal return optimization. It helps guide companies. If Growth Builder sees its ROIC is low because incremental turnover is poor, it knows to focus on asset use, not just chasing sales.
Makes sense. What else?
Third, strategic shift detection. Changes in the ROIC components over time. They can signal shifts in strategy, market conditions, early warnings.
So if growth builders' incremental margin dips, even if sales are up, maybe new competition.
Could be. Something you might otherwise miss. And fourth, acquisition analysis. For acquisitive companies, it helps check if bought businesses are generating returns through better margins or sales efficiency or both.
So if Growth Builders buys a smaller tech firm, this tells you right away if it's a margin booster or an asset efficiency play.
Instantly. It clarifies the contribution.
That photo versus video analogy really works. The article even shows how different combinations of incremental margin and turnover can lead to the same ROII, say 10%, but signal totally different strategies.
Yes.
Can you give us a more concrete example? Like, for growth builders, what might those 4 different lenses reveal if they hit 10% ROIC?
Absolutely. Okay, growth builders hits 10% ROIC.
Scenario 1.
High incremental margin, stable capital. Maybe they boosted NOPAT margin significantly, only a slight capital increase. Renegotiated supplier deals. Focused on high-margin software licenses. No new data centers needed. Strong differentiation play.
Okay, makes sense. Scenario 2.
High incremental turnover. Stable margin. They hit 10% ROIC by drastically increasing capital turnover. Optimized project management software. Got more sales from existing design assets, like using new routing software for equipment, no new warehouses. Points to cost efficiency, operational excellence.
Right. What about the negative ROIC scenarios we mentioned?
Okay, scenario 3. Lower capital, higher margin. This is the good negative one. Imagine they slim down, shed unproductive R&D labs, but the remaining assets. Hyper-focused, generating higher NOPAT. Overall ROIC might barely budge, but the incremental view shows brilliant capital redeployment.
Clever. And the bad one.
Scenario 4. Increased capital, decreased margin. They invest heavily in a new, unproven market, more capital, but struggle. Can't price effectively, NOPAT margin on new sales is poor. The overall ROIC might still look okay because of other stuff, but the decomposition flags that inefficient new investment immediately.
Wow. So it really is like 4 different lenses. It reveals the actual levers management is pulling.
Exactly. Far more nuanced than just one ROIC number.
Yeah.
Gives you a clearer picture of why they're performing as they are, what their strategy really involves.
And this raises that important question. How does this deeper look change how you might analyze growth builder strategy?
Precisely. For you as an analyst looking at their expansion, you can pinpoint if that new drone fleet is boosting project margins or just churning capital.
Or if their pivot into sustainable materials is working. This decomposition gives you that early warning the overall ROIC might miss entirely.
Exactly. For example, a truly positive scenario. Higher NOPAT, higher sales, lower invested capital, clear win, growth builders doing more with less.
The dream scenario.
Right. Conversely, lower NOPAT, lower sales, combined with higher invested capital. Major warning sign. The decomposition lets you reason about this stuff with much greater precision. Understand the specific levers, how efficiently they're being pulled.
So it's really about more than just the numbers. It's understanding the story, the narrative behind them. This deeper analysis, tracking incremental sales, margins, capital turnover, it links directly to intrinsic value drivers like sales growth, which other experts, like Ryan Telford, Michael Maupassant, highlight as crucial for finding multi-baggers.
Connects the dots.
Yeah, this granular view helps you connect those strategic decisions to long-term value creation in a way a single aggregate ROIC just can't.
Well put.
So what we've deep dived into today is, well, it seems like a truly novel and pretty intuitive extension of financial analysis.
It does feel that way.
Taking the familiar DuPont decomposition, applying it to return on incrementally invested capital, ROIC, and unlocking this powerful new lens, understanding precisely how companies create or sadly sometimes destroy value with their new investments.
And this framework, it provides invaluable clarity for you. Whether you're an executive charting growth or an investor sifting opportunities, it helps you look beyond the surface.
Understand the why.
Exactly. Understand the why behind performance, spot those strategic shifts that might otherwise just fly under the radar. It really enhances your ability to evaluate progress and the effectiveness of growth initiatives.
Okay, so for your final provocative thought, think about Growth Builders, Inc., or really any company you follow closely. How might analyzing the incremental changes in its margins, its capital turnover, through this DuPont-style ROIC lens reveal a completely different story about its recent strategy than just looking at the overall ROIC?
That's the question.
It just might be the insight that makes all the difference for your next investment decision, helping you see the growth story that's truly unfolding, not just the one reflected in the averages.